Welcome to the Explainer. So if you've ever stared at your investment options and just felt totally overwhelmed by the massive alphabet soup of financial jargon, believe me, you are not alone. Today, we're stripping away the intimidation factor. We're going to break this all down together and demystify four of the major financial vehicles: index funds, mutual funds, hedge funds, and ETFs. Okay, let's dive right into this.
Here's our quick roadmap for today. We'll start with what a fund actually is, establish our baseline with index funds, look at the active management side with mutual funds, take a quick peek into the highly exclusive world of hedge funds, and then finally, we'll cover ETFs. Let's get started.
All right, part one. What exactly is a fund? The foundation.
Before we get tangled up in all those acronyms, let's just look at the basic mechanics. At its absolute core, a fund is really just a pool of money. It's gathered from a huge group of people and then used to invest in a wide variety of assets. Things like stocks, real estate, or bonds. The real beauty here is that instead of you sitting alone at your computer, stressing out, trying to research and manage dozens or hundreds of individual investments all by yourself, the fund handles all that heavy lifting for you. You just get to share in the overall results.
Honestly, it's a lot like organizing a massive birthday party. Think about it. If you had to throw a huge party entirely by yourself, you'd be buying the food, the drinks, the decorations, the cake, hiring the DJ. It's exhausting and super expensive, right? But if you just pool your budget with a bunch of friends, well, suddenly you can afford all of those amazing things together. And this perfectly illustrates the core mechanic of an investment fund. Nobody has to cover the whole bill, but everybody gets to enjoy the full, diversified experience without the nightmare of managing it alone.
Moving on to part two, the baseline, index funds and passively tracking the market.
Now, these are those famous set-it-and-forget-it investments you constantly hear folks like Warren Buffett raving about. And why is that? Well, because an index fund doesn't try to outsmart the system or guess winning stocks. It just passively copies a list, an index, of companies. Think of an index like a giant scoreboard. The S&P 500, for example, just tracks the 500 biggest companies in the US. The NASDAQ, that tracks tech giants, your Apples, Microsofts, and Amazons. And the Dow Jones tracks 30 established industrial heavyweights like Coca-Cola and Boeing. The fund literally just buys whatever is on that list. No guessing, no late-night panic selling. You just get broad, diversified market exposure.
And here's the best part. Because it's passively managed, you aren't paying some high-priced Wall Street manager to sit in an office and pick stocks. You're basically just paying for an automated system. So the annual fees, which we call the expense ratio, are just incredibly low. We're talking somewhere between 0.02% and 0.20%. To put that in perspective, if you invest $1,000 with major players like Vanguard, Fidelity, or BlackRock, you might pay literally 20 cents to $2 a year in fees. It is incredibly cost-efficient.
But there is a pretty crucial mechanical quirk with index funds that you really need to know about. It's called the net asset value, or NAV. Unlike a regular stock, you can't just buy or sell an index fund at, say, 11 a.m. and lock in that exact price. No, index funds are only priced once per day, right after the market closes, usually around 4 p.m. Think of it like Cinderella's carriage, turning back into a pumpkin. That 4 p.m. mark is a strict cutoff time. If you place your order in the middle of the day, it won't actually execute until that end-of-day NAV is calculated. It keeps things simple, sure, but it does mean you completely lose that real-time control over the minute-to-minute price.
Okay, part three, active management, mutual funds, and trying to beat the market. So let's step up the ladder of complexity just a bit. On one side, we have the passive nature of index funds, right? Systems blindly following a list. But on the other side, we have mutual funds. These are actively managed. That means there's an actual professional fund manager or even a whole team of human analysts actively deciding exactly which stocks or bonds to buy and sell. And their explicit goal? It's not just to match the market. They're actively trying to outperform and beat benchmarks like the S&P 500.
But, and this is the crucial point, all that active human brainpower definitely comes at a cost. When you invest with big mutual fund providers like JP Morgan, for instance, you're paying the salaries of those professional teams. Because of this, mutual fund expense ratios jump up significantly, often landing anywhere from 0.5% to 1.5% or sometimes even higher. And here is the real catch. Studies consistently show that despite paying those higher fees, most actively managed funds actually fail to consistently beat the market over the long term. I mean, seriously, sometimes you'd be better off with a monkey throwing darts at a stock page. That said, a lot of investors still use them when they want targeted exposure to very specific sectors or foreign countries.
All right, moving to part four, the exclusive, hedge funds, high risk, high reward.
Forget everyday investing for a second. We are stepping behind closed doors now into a pretty daring world meant mostly for wealthy institutions.
Hedge funds are infamous for a very specific and, frankly, very aggressive fee structure called the 2 and 20 model. Basically, if you invest in a hedge fund, you're generally paying a massive 2% annual management fee on your total investment. Plus, and here's the kicker, the managers take a 20% cut of any profits they generate for you. This incredibly high fee structure essentially forces hedge fund managers to chase massive, outsized returns just to justify their own cost to investors. I mean, Wall Street yachts don't pay for themselves, right?
What's really fascinating, though, is how they actually try to get those massive returns. Hedge funds have almost total freedom to use highly aggressive, super complex strategies. They use short selling to actually bet that a company's stock is going to crash. They use leverage, which literally means borrowing money just to multiply their investment size. And they trade incredibly complex contracts called derivatives. Now, while the profits from these bold moves can be absolutely astronomical, the losses, they can be equally devastating. And that right there is exactly why these funds are legally restricted to high net worth, accredited investors.
Let's move to part 5, the hybrid. ETFs, basically the best of both worlds.
Let's bring things back to earth for the everyday investor. Think of ETFs, which stands for Exchange-Traded Funds, as this brilliant hybrid that merges the broad diversification of a fund with the fast agility of an individual stock. Remember that net asset value cutoff time we talked about with index funds? Well, here is where ETFs completely break the mold. While traditional index and mutual funds force you to wait until the end of the day to process your trade, ETFs are traded on the stock exchange in real time. You can literally log on to your brokerage app at 10:30 in the morning, see the exact to-the-second price of an ETF tracking the S&P 500, and hit buy or sell instantly. Plus, a lot of brokers' platforms today offer ETF trading with absolutely zero commission fees, which makes them incredibly flexible and accessible for all of us.
And the absolute best part? Because the vast majority of ETFs are passively managed, meaning they're just tracking an index, a specific sector, or an industry, their fees remain beautifully low. You are getting all that real-time trading flexibility, but with expense ratios that typically sit right down there between 0.03% and 0.75%. You truly are getting the best of both worlds, broad market exposure and ultimate trading control.
And finally, part 6, choosing the right fund, the final breakdown. We have covered a whole lot of ground today, so let's synthesize all of this data into your ultimate cheat sheet. Let's see how this all builds into a practical strategy for you. So, if you're an everyday investor just looking for long-term growth with the lowest possible fees, index funds are absolutely your bedrock. Now, if you want human experts targeting specific sectors and you don't really mind higher fees and end-of-day trading, mutual funds might be your play. If you're a highly wealthy, accredited investor willing to take massive risks for massive rewards, well, you're looking at hedge funds. And finally, if you want the low costs of passive management, but you really desire the flexibility to trade in real time on modern apps, ETFs are pretty much your perfect match.
Which brings us to the most important question of all. Which strategy fits your financial future? You no longer have to be intimidated by all that Wall Street jargon. You know the mechanics, you understand the fees, and you clearly see the risks. The power is now entirely in your hands to take control of your investments and build the exact future you want. Thanks so much for joining me on this explainer. Keep learning, and I'll catch you next time.